Good morning, everybody. Today we are looking at AASB 11 joint arrangements. But before we start, I thought I'll show you some of the functionalities of GoToMeeting. On the right-hand side of your screen, you should be able to click on a question box and there put in a question or respond to questions that I ask. So my first question is, who's going to win the T20 World Cup that's currently going on? I've got a few alternatives there. Right at the bottom, South Africa. Last night, my husband stayed up to watch South Africa play against the Netherlands. They nearly lost. So he was in a tremendous state of stress. So what do you think? Who's going to win? I don't think it's South Africa. I've got some votes for India, quite a few votes for India. Oh, a few Australians. Think Australia will do it? Yeah, I like the West Indies too, Alan. Yeah, so at the moment it looks as if I've got a number of people who think India can win it. So the options at the moment are, there's one for Pakistan, Michael. There's India, quite a number. There's one for the West Indies, a lot for Australia. Right, so nobody's voting for South Africa. What's going on? Maybe it's because they're so useless at the moment. Anyway, so you've found the question box. On the right-hand side, there's a question box. If you would like to post a question to me or make a comment at any stage, could you please use that? I'll try and monitor it as we go, but I have to say sometimes my multitasking is not that good and I can't read and talk at the same time. I don't know why. But anyway, I'll try and keep an eye on the question box. If I don't refer to your question at the end of the webinar, I'll have a look at the questions. So thank you very much for joining us. There are a few late voters, all for Australia, Stephen and Daniel. I want to say to the Australians, keep dreaming and hoping. But anyway, at least the South African has given up hope. So let's go on. The roadmap for this session. Within the next 45 minutes to an hour, we will look at the definition of a joint arrangement, which is a new definition. We'll look at joint control. We'll look at, in section 3, types of joint arrangements. In number 4, the financial statements of parties to a joint operation, and then also the financial statements of parties to a joint venture. And then in section 6, I would like to briefly look at the interaction between AASB 10, consolidated financial statements, AASB 11, joint arrangements, AASB 12, which is the new disclosure requirements for investments in other entities, and AASB 1 to 8, which is investments in associates, equity accounting. But that's really what we want to cover today. So let's start with the definition of a joint arrangement. So the words have changed a bit. I should start off by saying before the issue of AASB 11, joint arrangement, the old standard was AASB 131. And the terminology was very different, so you have to look carefully at the definitions in the new AASB 11 and not confuse it with the old terminology and the old definition. That's point 1. And then point 2, in the old AASB 131, there was an option. If you had a joint venture, you could either use equity accounting or proportionate consolidation, and it was an accounting policy choice. In the new AASB 11, there is no proportionate consolidation. There is no accounting policy choice if you've got a joint venture. So that's a big change. Now, it pains me to admit to this, but the Australians had it right all along. You will remember when the IFRSs were first adopted in Australia in 2005, the Australian Accounting Standards Board didn't allow proportionate consolidation. They said that's not an option, that's not a choice. Over the years, they've given in to the pressure, and specifically the pressure to be able to state compliance with IFRSs if you comply with Australian accounting standards, and the AASB reintroduced proportionate consolidation a few years ago. But now with the new AASB 11, they've been proved to be correct in 2005, and there's no proportionate consolidation. So that's a big change and something to note right up front. So definition of a joint arrangement. Now, a joint arrangement is an arrangement of which two or more parties have joint control. Now, it's important to note that if there are 5 investors in a joint arrangement on another entity, you could have a situation where 3 of the 5 have joint control. You don't need all 5 to be involved to have joint control. You could have all of them collectively have joint control, or you could have a subset who have joint control. So that's an important thing to look out for. Now, a joint arrangement has the following characteristics. The first one is the parties are bound by a contractual arrangement, which is important. We need that contractual arrangement. And then that contractual arrangement would give 2 or more parties joint control of that arrangement. It's important when you look at contractual arrangements, whenever I read contractual arrangements, I tend to automatically think it has to be a written contract. However, in the appendix to AASB 11, it says contractual arrangements are often, but not always, in writing. So we could have verbal contractual arrangements. So it's usually in the form of a contract. It's usually in writing. It could be documented discussions between parties. So we have a discussion over dinner and we decide we're going to start a new joint arrangement. And there we write down what are the key things we've talked about, just so we can remember tomorrow morning. Statutory mechanisms can create enforceable arrangements, and we often see these statutory mechanisms in the not-for-profit sector. So it's a contractual arrangement, it's in writing, but it's a statutory mechanism, it's a law or legislation. You can also have a contractual arrangement where it's incorporated in the articles, in the charter, or the bylaws of an entity. And again, in this last one, we often see in the not-for-profit space. So a contractual arrangement is not only a written contract. It could be a number of other things, which is important to note. So what would usually be addressed in these contractual arrangements? Now, it doesn't have to be there, but these are the things that we would usually find there. So the purpose, the activity, and the duration of our joint arrangement, how members of the governing body of the joint arrangement are appointed. Now, that's a very important thing. So if we've got 2 entities getting together to form this joint arrangement, and we've got a governing body consisting of 4 people, who would appoint members to that governing body? Do we each appoint 2 people? Important to know that. It's important to know and consider, so who would be the chairman of that governing body? And would that chairman have the right to have the casting vote if there's a deadlock? Because once we get into that situation, it could cloud the issue whether it's control or joint control. So it's very important that we look at this contractual arrangement and determine specifically who appoints the governing body, what are their voting rights, who is the chairman, if there's a deadlock, how is it resolved. The decision-making process is important. I think another thing to add is dispute resolution process, very important. So if there's a deadlock, how do we resolve it? And I think it's a good recommendation to say, if we want to get to joint control and not control, because once you get control, you have to consolidate. But if you want joint control, if there's a dispute and there's a deadlock, I think it's good to say we're going to get referred to an independent arbitrator to resolve the issue. Capital or other contributions required are included in the contractual arrangement. And then also, this is what we put in, but also how do we share the assets, liabilities, revenue, expenses, or profit and loss. So usually that's within this arrangement. A practical tip. The name of the agreement is not important. It only matters whether the agreement and the content of the agreement meets the definition of a joint arrangement as set out in AASB 11. So quite often people would come to me and say, look here, The name of this agreement says it's a joint operation agreement, or this, it's got a specific title, and therefore this is what it should be. The title is not important. The substance of what's included in that contract or that agreement, that's what's important. So understanding the terms of the contractual arrangement is imperative for evaluating whether joint control exists, and if so, also the type of joint arrangement. So first of all, we have to consider, do we have a joint arrangement? And then if we have a joint arrangement, we consider what type of joint arrangement do we have. I cannot say this enough. To understand the terms of a contract and the ability to read a contract and understand what the substance is, to summarize the key points of a contract is a crucial thing, because that guides your judgment on the position. And AASB 11, joint arrangement, as well as AASB 10, which we considered in last month's webinar, it's all about judgment and justifying your judgment. So let's look at an example. If we've got agreements with control and joint control, so let's say that A and B entered into a contractual arrangement to buy a building that has 12 floors, and they will lease those floors to other parties. Now, A and B each are responsible for leasing 5 floors, and each can make all decisions related to their respective floors and keep all the income with respect to their floors. So floor 1 to 5 is A, 6 to 10 is B, and they run the show, make all the decisions. The remaining 2 floors, let's say the top 2 floors, are jointly managed. All decisions with respect to those 2 floors must be unanimously agreed between A and B, and they share all profits equally. I just want to state this. The fact that they share all profits equally doesn't make it a joint arrangement. You can share your profits 80%, 20%, and still have a joint arrangement. The key word that you're looking for when you consider a joint arrangement is, do we have unanimous decision-making? And that we see here, for those 2 floors, we have unanimous decision-making. So in this example, there are 3 arrangements. We can have 1 contract. But if you unbundle the contract and the substance what's there, you would say you've got 5 floors that's controlled by A, and they would account for it under the relevant standard. We've got 5 floors controlled by B, and then we've got 2 floors that A and B jointly control. It's a joint arrangement. There's unanimous decision-making required, and therefore it's within the scope of AASB 11. The next section that I want to look at is a bit more on joint control. Now, we've looked in section 1 on a joint arrangement, and it's very important to start there. Do we have a joint arrangement? Because only if we have a joint arrangement would AASB 11 be applicable. So that's the first part. If we look a bit further onto joint control is the contractually agreed sharing of control of an arrangement, which exists only when decisions about relevant activities require the unanimous consent of the parties sharing control. Very important that you understand the meaning of relevant activities and unanimous consent. Relevant activities is a concept that's defined not in this standard AASB 11, but actually in AASB 10, Consolidated Financial Statements. So it's really saying, if we start this joint arrangement, and let's say the relevant activities would be the significant, the key, the important activities that would influence the success of the business, the strategy, the vision, where we're going to buy this property, our investment decisions, long-term vision strategy. Other activities could be, a relevant activity could be the appointment of key management personnel, because they're going to execute your strategy. Other activities could be more of an admin nature or bookkeeping nature. It's important activities, very important activities, but you know, who appoints that person is not important. We need HR, we need finance, we need all of that. But if we want to look at the future, the strategy, we have to look at what are those activities, significant relevant activities. So one, what are the relevant activities of the joint arrangement? And then who makes those decisions? Now, if one person would make those decisions, we would argue that they control. However, if unanimous consent is required to make those decisions, then we have joint control. So if we look at joint control, there's a two-step approach. So step one is, does the contractual arrangement give all of the parties or a group of the parties? So it could be all 5 of the parties, or it could be 3 of the 5 parties. But does the contractual arrangement give all of them or a group of them control of the arrangement collectively? So somehow can we say a group of them together have control of the arrangement? So let's say we look at a situation where we've got 5 entities involved in the joint arrangement, and each have 20% voting rights over the relevant activities. We could say if 3 of them get together, the 3 of them together have 60% of the voting rights over relevant activities, and it's not a bright line 50% anymore, but they have the power over the relevant activities to influence the future outcomes. Then we could say that group of 3 collectively have control. Then step 2, do decisions about the relevant activities require unanimous consent of all the parties or of that group of 3 of parties that collectively control the arrangement? And as soon as we say yes, unanimous consent by all 3 of them to make decisions, then it's a jointly controlled arrangement. It's a joint arrangement. We are in AASB 11. So it's a two-step approach. As soon as you say a group of them or all of them don't have collective control, you are outside AASB 11. As soon as you say unanimous consent is not required, you're outside AASB 11. It's really important to determine whether you're in or out of AASB 11. So a bit more on step 1. So we ask, or we need control of the arrangement collectively, and we want to look at relevant activities, and that is activities that significantly affect the returns of the arrangement. If you look at step 2, unanimous consent, so joint control only exists when decisions about the relevant activities require unanimous consent of the parties. So if we look at this a bit more, in a joint arrangement, no single party controls the arrangement on its own. As soon as a single party controls the arrangement, they indeed have control and they have to consolidate. So with a joint arrangement, we need at least 2 parties to collectively have control, and control as defined in AASB 10. And then important that if you're a party that has joint control, you can prevent any of the other parties or a group of the parties from controlling the arrangement. Because we've got this concept of unanimous consent, if 2 of us control an arrangement and we need unanimous consent, if I don't want to do it and the other party wants to do a certain new expansion, because there's a deadlock, we need unanimous consent, we cannot move any further. So that's where that dispute resolution process is very important. A few other things to consider. An arrangement can be a joint arrangement, even though not all of the parties have joint control. So if we've got 3 of the 5 that have joint control, that's good enough. You don't need all of them. And an entity will need to apply judgment when assessing whether all the parties or a group of the parties have joint control. AASB 10 and AASB 11 has made the whole classification on whether we've got control, whether we've got joint control, whether we've got significant influence, very judgmental. And therefore, my advice to clients would be to document your judgment and justify your judgment in order to have that discussion with your auditor. Really important that we document, justify our judgment, discuss it with our auditor, and then AASB 12, the disclosure standard, requires us to disclose our judgment. Because there are no longer these bright lines, and because we have to apply our judgment, we have to explain to the users of the financial statements how we've applied this judgment, what assumptions we've made, what we've considered. So that disclosure is actually really important. And then an entity shall make this assessment or this judgment by considering all facts and circumstances. So there's not really one thing that's the key thing. There's a number of facts and circumstances that we have to document in a position paper to justify our judgment, and it's on the balance of facts and circumstances. Important, if facts and circumstances change, and only if facts and circumstances change, will an entity reassess whether they still have joint control. So it's not as if there's a continuous assessment required, but it's a continuous assessment only if facts and circumstances change. So let's look at a few examples about this two-step approach. And at this stage, I'm only looking at, do we have a joint arrangement, yes or no? Later on, we'll look at the type of joint arrangement. So in example B, I've said 75% of the votes are required to make decisions about the relevant activities of the arrangement. Remember, it's all about the relevant activities. So in these situations, the parties to the arrangement hold their voting rights as follows. A, 50%, B, 30%, and C, 20%. Now in step 1, we should ask, does collective control exist? So could two of those people control the relevant activities? Now you would say, because we need 75% of the votes, if A and B act together, they exceed the 75%. If A and C act together, they don't reach the 75%. If B and C act together, they don't reach the 75%. So the only combination that could get to that 75% is A and B. So A and B could have collective control. Step B, does joint control exist? Now, in brackets, I would say in order to get to joint control, you need unanimous decision-making. So in this instance, would we need unanimous decision-making by A and B in order to get anything done? And I would say yes. Because if A and B don't agree, there's no way we can make any decisions and move forward. So it's very important, only A and B could get to 75% and only if they agree. Therefore, implicitly, we've got unanimous consent. So is this a joint arrangement? Yes. Let's look at another example. In this example, 51% of the votes are required to make decisions about the relevant activities of the arrangement. So we only need 51% in order to control the relevant activities. We've got A with 50%, B with 50%. Do we have collective control? Yes, A and B together could direct the relevant activities. That's the first step. The step 2, do we have joint control? So do we need unanimous consent? Yes, because A cannot move on its own and B cannot make decisions on its own. Only if the two of them agree will we be able to make decisions. So therefore, again, we have unanimous consent as a requirement and it's a joint arrangement. Now let's look at another example. Now in this example, I've said 75% of the votes are required to make decisions about the relevant activities. And if you look at the parties to this arrangement, A has 50%, B has 25%, C 25%. So do you think collective control exists? We would say yes. A and B could get to 75% or A and C could get to 75%, B and C not. So there are two combinations. So if we now go to step 2, does joint control exist? Do we need unanimous consent? we would say there's no contractual agreement between A and B or between A and C to agree on relevant activities. So it's not as if we need unanimous consent of A and B in all situations to make decisions, because sometimes A and B would agree and they make a decision, and other times A and C agree and they make decisions. So there's no way we can say A and B have joint control in all situations, or A and C have joint control in all situations. It depends. There's no specific requirement for unanimous consent by A and B or A and C. They can chop and change. Therefore, it's not a joint arrangement. We don't have joint control. Another interesting thing is the concept of de facto joint control. Now, again, in last month's webinar, we talked about de facto control. And again, it's one of those things where the Australians have had it right all along. Before the adoption of IFRS in 2005, in Australia, we had the concept of de facto control. After the introduction of IFRS, we kicked it out. But now, with the introduction of AASB 10 and AASB 11, we are back to de facto control and de facto joint control. So if we look at de facto joint control, we need two components. We need collective de facto control, as defined in AASB 10. Again, we need unanimous consent. Unanimous consent is crucial in order to get to a joint arrangement and joint control. So if you've got collective de facto control, you've got unanimous consent, or you need unanimous consent to make decisions, you've got joint de facto control. So let's look at that through an example. I think that's the best way to explain it. So let's say A and B have an arrangement in which they each have 24% voting interest. And let's say the key thing here is voting interest. I understand that with the new AASB 10 there is no bright line 50%. However, in my example, to keep it simple, I'm arguing you've got power if you've got more than the 50%, because voting interest is one of the things to consider. So A have 24%, B have 24%. They say decisions about relevant activities, it's always relevant activities, require a majority of voting rights. So we need at least 51% in order to make decisions. The remaining 52% of the interest in this arrangement is widely dispersed. Therefore, in this situation, we will look at that. We don't only look at shareholding, we also look at how many people are involved in the arrangement, how actively they're involved, whether they attend meetings, whether they act together, whether they vote together. And let's say that the 52% is widely dispersed, they don't know each other, they don't act together. Looking at past experience, they don't even attend meetings. We could say, you know, joint control is a possibility, de facto joint control. To make things stronger, that A and B have an agreement. Remember, in order to get to a joint arrangement, we need some kind of agreement or contract. A and B have an agreement that they will agree on decisions about relevant activities. So A and B have a contract and that they'll agree, so there's unanimous consent about relevant activities. So A and B, collectively, A and B have de facto control. So they have power in terms of AASB 10 without a majority of the voting rights. So together they've got 48%, but because the other people, the other 52% are widely dispersed, they don't act together, we could say A and B collectively have de facto control. So that's the first thing. The second thing, because they've got this contractual arrangement that require unanimous consent, they've got joint control. So in this situation, we've got de facto joint control, we've got unanimous consent in terms of the agreement, and therefore in this situation, we would have a joint arrangement. So, so that was example E. Let's look at another example, example F. So in this situation, A and B have an arrangement in which they each have 24% voting interest. Decisions about the relevant activities require a majority of the voting rights, so at least 51%. The remaining 52% is widely dispersed. Now, in practice, that wouldn't be enough to justify a certain judgment. You'll have to consider whether the 52% act together, whether they've attended meetings in the past, some more information than just we've got a lot of other people in this arrangement. In this example, in example F, A and B do not have an agreement that they will agree on decisions about relevant activities. They don't have an agreement. That's our one problem. Secondly, there's no requirement to have unanimous consent. Therefore, in example F, although collectively A and B have de facto control, so that is power without a majority of voting rights, since there's no requirement for unanimous consent between A and B, there's no joint control. In this situation, you would say, how do we account for this? We've got de facto joint control. How do we account? We've got de facto control. How do we account for it? A and B would likely each have significant influence over the arrangement, therefore use equity method of accounting in terms of AASB 1 to 8. So A won't have control on its own, B don't have control on their own. A and B have de facto control, so that's power without a majority of voting rights. However, because they don't have unanimous consent, they're not within AASB 11. So where are they? I think they each have significant influence, or likely to each have significant influence, and therefore apply equity accounting in terms of AASB 1 to 8. All right, so that's an introduction. We first have to determine whether we've got joint control, whether we've got a joint arrangement, whether we are within the scope of AASB 11. And that's a real big part of it. It's judgmental. You have to document it. Really important to assess that. Once we've done that, the next decision is to look at the type of joint arrangement that we've got. Now, if you look at a joint arrangement, you could either have a joint operation or a joint venture. Please note, the terminology that we use here is different to the old AASB 131, where we have three different types of joint arrangements. So here, a joint arrangement can either be a joint operation or a joint venture. What is a joint operation? What's the substance of a joint operation? A joint operation is where the parties have rights to the assets, and where the parties, and it's important, it's and, have obligations for the liabilities relating to the joint arrangement. So the individual parties to this joint arrangement have rights to assets, so they could have legal title in assets, and they also have obligations for liabilities. So if this joint arrangement don't pay all their debts, the bank or the creditors would come to the individual parties and say, you have to pay it. So there's direct relationship between the parties and the assets and the parties and the liabilities, which is a big thing. On the other hand, when you look at a joint venture, in a joint venture, the parties have rights to the net assets of the arrangement only. So whatever's in the arrangement, the net assets, the assets and liability, if we come up to a net amount, I can get a part of that. I can get 50% of that. But I cannot go in and say, this is my asset, this is liability. Very importantly, if this joint venture don't settle all its debts, the banks usually cannot come to each individual party and say, listen, you have to settle the debt. So it's important to see, is there a direct relationship between the party and the assets and liabilities, therefore a joint operation, or whether the parties only have rights to the net assets, the leftover assets in that entity, which is then a joint venture. Now, I always use a very simple example. I love cooking, absolutely love cooking. I love eating too, by the way, but love cooking, and I always think cooking can give us a good example to remember the distinction between a joint operation and a joint venture. Now, in South Africa, we like to make a dish called potjiekos, which we make in a big black pot on an open fire, usually. So even today in Australia, when we camp, we like to make potjiekos in our open fire with this pot. A joint operation, my big black pot is the joint arrangement. If it's a joint operation, we would say I throw in some potatoes and somebody else, another family camping with us, they would throw in some carrots, and another family would throw in some chicken. So we throw it in this big pot. So we've got potatoes, carrots, and we've got chicken. And 6 hours later or 6 months later, we can lift up the lid and we can say, okay, those are my potatoes, those are your carrots, those are your chicken. So there's this relationship between the party that contributed the asset and the party that can then come and take the asset back or is responsible for liabilities. There's that direct, clear relationship. That's a joint operation. However, if we've got a joint venture, in this cooking example, if I've got my big black pot and we throw all those ingredients in, I throw potatoes, somebody else carrots, somebody else chicken. Usually South African, we like red meat. Let's say we throw in a bit of lamb. We add water, we add heat. It becomes a lovely, lovely potjiekos, or you would call it a stew. But after 6 hours, because this takes a long time, when you lift up the lid, you cannot say, listen, those are my carrots, those are my potatoes. It's all mixed up in the stew. The only thing you could do is say, listen, we are 3 families that contributed to this big joint arrangement, this big pot. A third of it is ours. And you just go in and you take out and you dish up whatever you can find. In that situation, the parties that contributed to the joint arrangement have rights to the net assets, to the soup or the stew or whatever's in the pot. But there's no direct relationship. These are my potatoes, these are my carrots, this is my chicken. Right, so that's how I try and think about the two. A joint operation is a direct relationship between the parties and what is in the joint arrangement, the assets and liabilities. With a joint venture, you look at it and you say, I don't have a right to any specific asset, or I'm not responsible for any specific liability. However, I have a right to the net, to the leftover, and I've got a percentage right to that. So a practical question. The definition of a joint operation refers to having rights to the assets and obligations for the liabilities. Now this begs the question whether a joint arrangement could be a joint operation if it has either rights to assets or obligations for liabilities, but not both. Now, it's a question of judgment, facts and circumstances. My personal view, you need both. You need rights to assets and then also obligations for liabilities. I think in real life, if you've got a right to an asset, you would always also have an obligation to settle the liabilities associated. Or if you've got an obligation for a liability, you would want to make sure that, yes, I've got an obligation for that liability, but it's secured by a right to a specific asset. So I think in practice that is in place, but I think you need both, and the definition refers to both. So if you look at the structure of a joint arrangement, again, this is a big change from the old AASB 131. If your joint arrangement is not structured through a separate vehicle, so this joint arrangement, it's not in a separate partnership or a separate trust or separate company or some kind of separate vehicle, then it can only be a joint operation. All right, so that's easy. If there's no separate vehicle, it's a joint operation. As soon as it's structured through a separate vehicle, there's no definitive answer. Now you have to consider the legal form of this vehicle, the terms of contractual arrangements around this vehicle, and any other facts and circumstances to determine whether you have a joint venture or a joint operation. So this is where the judgment comes in. Please note, this is very different to the old AASB 131. In the old AASB 131, as soon as your arrangement was structured through a separate vehicle, it was always a joint venture, end of story. Now, It's structured through a separate vehicle. Now you have to apply your judgment whether it's a joint venture or joint operation. Big change. So how do we do this classification? Nice decision tree. We start off with, is the joint arrangement structured through a separate vehicle? So if you say no, then clearly it's a joint operation. End of story. If you say yes, it is structured through this vehicle. Next question. Does the legal form of this separate vehicle give the parties rights to the assets and obligations for the liabilities relating to the arrangement? So even though there's a separate vehicle, can we still see that the parties have rights to assets and obligations to liabilities? If they still have that, we would say yes. If we answer yes to that, it's a joint operation. As soon as you've got rights to assets and obligations for liabilities, it's a joint operation, end of story. If you say no, for instance, it's a company, I can't say these are my assets, these are my liabilities. I've thrown them into the company, therefore they know the assets and liabilities of the company, and I'm just entitled to a percentage of those net assets. If you say no, you now have to say, do the terms of the contractual arrangement specify that the parties have rights to the assets and obligations for the liabilities relating to the arrangement? So could there be certain contracts that alter the legal form of the separate vehicle, and therefore the terms of this contract would give certain parties rights to certain assets and obligations for certain liabilities? If that's the case, if you answer yes, it's still a joint operation, although it's a separate legal vehicle. However, if you say no, you say, are there any other facts and circumstances, anything, that give the parties rights to the assets and obligations for the liabilities relating to this arrangement? If you say yes, joint operation. If you say no, finally, we're a joint venture. So separate vehicle. So what is a separate vehicle? A separate vehicle is defined as a separately identifiable financial structure, including separate legal entities or entities recognized by statute, regardless of whether those entities have a legal personality. It doesn't have to be a separate legal entity, therefore. So examples could be a partnership, a corporation, a company, a trust, a syndicate. But the last one is the interesting one. It could be a silo. Therefore, it's a deemed separate entity. So you've got an entity and you've created a silo within the entity. That silo is deemed as a separate entity. In substance, all the assets, liabilities, and equity of that deemed separate entity are ring-fenced from the host arrangement. So if we can ring-fence a part of our entity and say this division and these assets, these liabilities, we put into a joint arrangement, then we could say it's a separate entity for the purposes of AASB 11. It's a deemed separate entity. It's a silo. So that one is really interesting and creates a few issues. So why is this separate vehicle so important in the new AASB 11? The International Accounting Standards Board concluded that it would be rare for a joint arrangement, it would be rare that a joint arrangement would give parties rights to the net assets without having a separate vehicle. So they say, only if you've got this separate vehicle, only if you've got this separate ring-fenced area, would the parties have an interest in net assets. If it's just we get together, you bring this asset, I bring this liability, or I've incurred this liability to buy this specific asset to contribute, usually the parties would maintain an interest in the asset and would be responsible for the liability. Therefore, they've said if there's no separate vehicle, it's just a joint operation, end of story. But just remember that concept of a silo, a deemed separate entity. Remember, we also said we have to consider contractual terms. So I've got a few slides on what are the common contractual terms that would indicate the existence of a joint operation, and what are some common contractual terms that could indicate the existence of a joint venture. Remember, you have to look at all the contractual terms. You have to look at the legal form. You have to look at facts and circumstances. You have to look at all of that, and on a balance of that, you have to make a determination whether you've got a joint operation or a joint venture. So if you look at the rights to assets, a joint operation, the parties share all interests, that is rights, title or ownership in the assets relating to the arrangement in a specified proportion. So if we've got a building, I've got ownership or title to 50% of the building and the other party maybe the other 50%. So it can be in a specified proportion. That specified proportion doesn't have to be an equal proportion, just a specified proportion. It could be 80-20. Remember, to get to a joint arrangement, however, you needed unanimous consent. So would you be happy to have an arrangement with unanimous consent if your proportion is 80%? That's the question. So that's the kind of things to think about. And that's why unanimous consent is so important. Rights to assets, if it's a joint venture, the assets brought into the joint arrangement or subsequently acquired by the joint arrangement belong to the joint arrangement or to this joint venture. So we put the assets in and the title or the ownership is in the name of the joint arrangement. The parties individually have no interest, no rights, title or ownership in the assets of the arrangement. So the assets of the arrangement belong to the arrangement. Then it would feel more like a joint venture. What about obligations for liabilities? The parties could share all liabilities, obligations, costs and expenses in a specified proportion, no need to be equal. Also, the parties are jointly and severally liable for the obligations of the arrangement. So if this arrangement are not paying their debt, the bank could come and say, you as the parties in this joint operation have to pay. So the parties are liable for claims raised by third parties. A joint venture is separate, is different. In this instance, the joint arrangement is liable for debts and obligations of the arrangement. The parties are liable under the arrangement only to the extent of their respective investments in the arrangement. So there's a cap. You are responsible for debts up to the limit you can lose your investment, but not anymore. So similar to what we've got in a company. Creditors of the joint arrangement do not have rights or recourse against any party with respect to debts or obligations of this arrangement. So they can go after the joint venture or the joint arrangement, but they cannot go and collect the debt from the individual parties. So that would give us the idea it's a joint venture. What about restrictions on selling output? A joint operation, usually they are restricted from selling output to third parties. So they've got a joint arrangement or joint operation to come up with a certain output and then they will use it. And it goes to the two joint operators. With a joint venture, there are no restrictions. They could sell the output to anybody else because they want to make money in this joint arrangement. What about requirements to purchase output? A joint operations, usually the parties, individually or collectively, must purchase substantially all of the output produced. So this we often see in the mining industry. A joint operation, we're going to collectively mine in a certain area and we will individually or collectively purchase the output. A joint venture, there's no requirements for the parties to purchase the output. They can actually sell the output to other third parties. What about the source of cash flows to pay liabilities? If it's a joint operations, the source of cash flow would be the parties to the joint arrangement. With a joint venture, usually the source of cash flow would be third parties through their purchase of the output of this joint venture. So a joint venture, we get together, we're going to manufacture something, or we're going to explore, we're going to sell it to third parties, and that's where we get our cash flow from. What about expected financial performance? A joint venture is designed to generate a profit. With a joint operation, it's often designed to operate at break-even or to generate losses that will be funded by the parties involved. Because they put in the cash flow, they fund the losses. The idea is to get to a break-even position and share it between the two joint operators. A joint venture, usually it's all about profit. All right, so why is it so important? We've got a joint arrangement, AASB 11. Why is it so important to know whether it's a joint operation or a joint venture? Because it's crucial. Why? Because if you've got a joint operation, this is how you would account for it. A joint operator shall recognize in relation to its interest in the operation. Remember, there's a direct interest in assets and a responsibility for liabilities. So they can see their veggies, their chicken, their carrots. They will account for their assets, including a share of the assets jointly held. They would account for its liabilities, including a share of the joint liabilities, because remember, the bank can come and collect the debts from any party. They will account for its revenue from the sale of its share of the output arising from this joint operation. So if I'm entitled to 80% of the output and I then sell it as a profit, that's my revenue. My share of the revenue from the sale of the output of the joint operation. So if a portion of the output is sold to third parties, I'll account for my part of the revenue. And if we look at expenses, the expenses that you've incurred and also a portion of the joint expenses. So if it's a joint operation, you will account for your assets, your liabilities, your revenue, your expenses in respect of the joint operation, as well as making sure a portion of any assets, liabilities, revenue, expenses incurred jointly. So this could lead to an impact on every line in your statement of comprehensive income and every line in your statement of financial position. But it's only your interest. So that's a big difference. If you look at a joint venture, we no longer have an accounting policy choice. If it's a joint venture, there's only one thing. You'll recognize your interest in the joint venture as an investment, and you'll account for that investment using the equity method in accordance with AASB 128. So there is no proportionate consolidation as an alternative if you've got a joint venture. Big change from AASB 131. I want to end the webinar, and it's nearly 12 o'clock. I want to end the webinar on showing you a diagram on the interaction between AASB 10, Consolidated Financial Statements, AASB 11, Joint Arrangements, AASB 12, the Disclosures, and AASB 128, Equity Method of Accounting, where you've got significant influence, or in AASB 11 you've determined that you've got a joint venture. So I've sent you a Word document. I'll just go out of my PowerPoint and go to the Word document. And it would be nice if I can see the whole thing on one page. There we go. So I've said the interaction. You start with the first question is, maybe it would be nice if I can get some kind of a spotlight. Your first question is, does the investor control an entity on its own? If you say yes, we control this entity on our own, and it's a new definition of control, no longer the bright line of more than 50%, but rather do I have the power over the relevant activities to significantly affect returns. So if I've got control, I say yes, I consolidate, and even though I consolidate, I still have to do AASB 12 disclosures because I've got an investment in a subsidiary. If I go back to that question, does the entity investor control an entity on its own? You say no. You say, okay, does the investor have joint control over this arrangement? So joint control with somebody else. If you say yes, you say Okay, now I have to consider whether it's in AASB 11, is it a joint operation or is it a joint venture? If it's a joint operation, I would account for the assets, liability, revenue and expenses separately in separate line items, and I still have the disclosures in terms of AASB 12. If it's a joint venture, it's equity method, AASB 1 to 8, and still the same disclosures. However, if we go back to the second question, does the investor have joint control? So we've said we don't have control on our own. We don't have joint control with somebody else. We say no. We will then ask, do we have significant influence over the entity? Now, significant influence in AASB 1 to 8 is still when you've got an interest between 20 and 50%. You could argue that you might have significant influence. You don't have control. You don't have joint control, but you've got significant influence on strategic and financial decisions. If you say yes, you are also in AASB 1 to 8. If you say no, you could have just a financial instrument in terms of AASB 1 through 8, or it could be another standard. So interesting to note, if you've got significant influence, you have equity method of accounting. But if you've got joint control and it's a joint venture, you have the same equity method of accounting. And it doesn't matter whether you've got control, joint control, significant influence, or financial instrument, investment in shares. Disclosures are required in terms of AASB 12, and it's a new standard, new disclosures. That AASB 12 require you to disclose how you've applied your judgment to determine whether you've got control, joint control, or significant influence. And if you've got joint control, how did you determine whether you've got a joint operation or a joint venture? So if I go back to my PowerPoint slides, so that's just a nice big picture to see it all in perspective. Back to the slides. So we've referred to the diagram. So what did we do in the session? We looked at a joint arrangement. We looked at joint control, which is unanimous consent. We looked at types of joint arrangement, a joint operation or a joint venture. We've done some cooking there as well. We've looked in section 4, so how do you account for a joint operation? You account for the assets, liabilities, income, revenue, in your financial statements, and if it's a joint venture, you account for it as an investment, equity method of accounting, and we've also looked at a bit of a big picture. So at this stage, if you've got any questions or comments, please send them through, phone me, email me, happy to speak to you, but thank you very much for joining me. I've got 2 minutes to spare. I've really been going like a steam train today. Thank you very much for joining me. I hope you've got a great weekend. And go the Aussies.